Hello everyone. In today's lecture, we are going to learn about technical analysis. Now, if we go over with the word technical analysis, we are going to divide this word in two parts. First will be techni and second will be cal. Now, what do you mean by word techni? Techni means your techniques, the tools and the methods you are going to use. Or we can say that technique means the methods, patterns, and indicators you study for the market. For example, if you study the candlestick chart or you study the moving average, how the prices are moving. So that is known by word technique. And if I talk about word cal, as we all know, cal means calculations. So calculations refer to the interpretation of numbers, your interpretation of price, how the trend is there, whether there is an upward trend, whether there is a downward trend, whether the market is stochastic. So that means we are going to study two things. One, with the help of techniques, tools and methods, and then with the help and with all these techniques, tools and methods, we are going to do the calculations. So methods and calculations are applied to the market data. Whatever the stock market data will be there, we are going to apply these things on that so that we can predict the future price movement of your stock. Now let's talk about some examples. Let's say if you want to predict the weather condition. So what you will observe, you will see whether today is a rainy day, whether yesterday was a rainy day or day before that yesterday, how the season, how the temperature was there. So based on the previous temperature, we can predict the future temperature. Whether today will be the sunny day, whether tomorrow will be the sunny day, whether tomorrow will be the rainy day. So that means your prediction of the weather also depends on the past weather. Or let's say you are driving a car and you want to predict your next movement, whether you have to go move towards the right, whether you have to move towards the left. So what you are going to see, you are always going to view your rear view mirror and you are going to observe your dashboard signals. So based on this, you are going to predict your next movement. Or let's say you are making your fitness chart. Every day you write your weight, and if your weight is increasing, that means you are saying you are in an upward trend. And if your weight is decreasing, that means you are losing your weight. You say you are in a downward trend. And it can also happen that your weight is stable. And if your weight is stable, so you are saying that you are moving horizontally. It's stable. It's neither moving up, neither moving down. So on the basis of that, you can predict your weight, whether whatever diet you are following or whatever you are doing for your fitness, whether your weight will move up, whether your weight will move down, or whether it will be stable. Or let's take one more example. Whenever you are going out, you always observe your Google Map. And Google Map always tell you whether there is a traffic, whether your road is free, at how much time you are going to reach it. So that means you are seeing the pattern to predict your move. So similarly in stock market also, we use some techniques, we use some calculations to predict the next stock prices. Now whenever we talk about this technical analysis, there are certain assumptions in the technical analysis regarding to your stock market. So the first thing is that stock market discounts everything. Now what do you mean by word discounts everything? Now let's understand with the help of example. Let's say you are going to buy some vegetables. Let's take a common examples of tomatoes and onions. Now let's say that normal price of your tomatoes and onions is 50 rupees per kg. But now these days the prices are 120 or 150 rupees per kg. Now what you will say if the prices are increasing? If the prices are increasing, that means there is a shortage of these tomatoes and potatoes, or you can say demand is more. So that means the shortage may be due to the flood or spoilage of your these vegetables. So that means the prices, that means you are aware that there is some flood or there is something happens that the supply of these tomatoes and potatoes is less. Or let's take one more example. Now let's talk about the movie ticket. You want to purchase a movie ticket, and the for the movie for which you want to purchase a ticket, that is a blockbuster. And if a movie is a blockbuster, it means ticket prices will increase. And even before the release of that movie, the prices will increase. So that means the demand for the ticket will increase. So that means it is reflecting that the movie is a blockbuster. Or let's take one more example. Let's say before earning results, the investors expects the bad performance of the prices. Or investor says that prices are falling even before the official announcement. Maybe the company has not announced the dividend, but investors are aware that the company is not earning good, so the company is not going to pay the good dividend. So that means whatever is happening in the market, whatever the news are prevailing in the market, that are already seen in the pattern of the stocks. So we can say that whatever news, maybe the good news, maybe the bad news, or let's say if you will observe the COVID, when the COVID came, the prices decreases. So that means that is a bad news. So bad news is already absorbed by the stock market. So that means all the news, whatever the events are happening, investor psychology, that means investor psychology about supply or demand forces are already reflected in the price. So that means market discounts everything. So whatever is happening in the market, that is reflected in the stock price. Okay. Now for the next part says that today's price depends on the past price. Let's say I'm just giving you a small example. Let's say whatever you are observing, a smiley face. Now, why you are smiling? Let's say this is your face and I'm saying you are smiling right now. But why you are smiling right now? Maybe you are thinking something. Or let's say I'm thinking that last week I won a trophy. So today I am smiling because why? Because yesterday I won a trophy. So just thinking about my yesterday winning, I'm smiling in today's date. So that means my today's happiness depends on my own past. So the second assumptions of technical analysis says prices depends on their own past. The past can be 1 day back, it can be 2 days back, it can be 3 days back. So today's prices are depending on its previous day or day before yesterday or 4 days before yesterday or 4 days before today. So we can say price depends on its own past. Now next comes the seasons. Now what do you mean by word seasons? Seasons means winter season will be there, then summer season will come, and then the monsoon will come. So have you ever observed these seasons? There is a repetitive pattern. Whenever the seasons are there, repeated, every year winter is there, every year summer is there, and every year the monsoon is there. So we can say that history repeat itself. Or let's say one more example, let's say fashion trends. If I talk about fashion long before, there was a fashion, the clothes are like bell bottoms were there, retro glasses were there. But again, if you are seeing today, all these fashions are coming back. So that means history repeat itself. So similarly, we can say that in stock price also, the previous patterns come again and again. Or let's say one more example. If you will observe, every semester students are giving exams. And every semester before the exam, students are nervous. So that means there is a repeating pattern of students' behavior. Every time it will happen. So similarly, the chart patterns like your head and shoulder, double top, your bull and bear cycle have the appearance from decades. That means they will appear again and again in the stock market. So we can say that in technical analysis or whenever we are studying these charts, history repeat itself. Next is prices move in a pattern. So whenever you will see this chart, you will see that prices are moving in a pattern. Okay, let's understand with the help of an example. Let's say a ball is rolling down from the hill. You are standing on the hill and you have just thrown the ball down. So ball will roll down through the hill and it will keep going on until someone will stop that ball. Or you can say someone is forcing that ball to stop. So then only that ball will stop. Or let's say there is a student who is working very hard and the student is consistently improving its grades. So that means every semester the student is showing the upward trend because the grades are improving every semester. So unless and until that student is going to change its habits, that trend will continue. Let's say the student is working hard and something happens and the student mind is distracted. So at that point, the pattern will change. At that point, he will start losing its marks. So similarly, the prices also moves in certain pattern. Or let's say if I talk about the Diwali season. Whenever Diwali season is there, shopping is there. And you will see that everyone is there who is going for a shopping. So shopping picks up the demand. And it keeps on rising unless and until the seasons end. So that means whenever we see the price pattern in the stock market, either there will be an upward trend, whether there will be a downward trend, and it keeps on going upward or it keeps on going downward unless and until something happens and it changes direction. For example, if I say that the prices are moving up, but suddenly the COVID came and prices moves down. So that means something happens in the market and it changes the direction. So we can say that technical analysis means your past data and some price patterns. With the help of these two things, we can expect the future prices. Now let's move towards the different kinds of charts. So the first is your candlestick chart. Now candlestick chart will look like this and this will be your opening price. This point, or you can say this edge, will be your closing price. Over here, this will be your lowest price. These are two legs, or you can say two shadows. This will be your lowest price and this will be your highest price. And this is your body. Now you will observe over here, I have made a green candle. So it can be a green candle or I can also show you the white candle. So whenever green candle or white candle is there, it means the market is bullish. Now what do you mean by word bullish? Now bull is an animal which always looks upward. So bullish means when the prices are rising. So in that case, when the prices are rising, it means your closing price are greater than your opening price. Opening price is, let's say, 5 rupees. So your closing price is 10 rupees. So that means upward trend. Prices are rising. Bullish market is there. And if the candle is red or black, so in this case, this edge will be your opening price. This is your closing price. Now you can see closing price is downward and opening price is upward, which means that opening price is greater than your closing price. This is your lowest price, this is your highest price, and this is your body. So once we have done green or white candle is a bullish, so closing price is greater than opening price, but in the red and black candle, it means bearish. That means bear is a animal which always looks down. So prices are decreasing. So closing price are less than your opening price. Now let's talk about more candlestick chart. So as you are seeing over here, your bearish is downwards and your bullish is upward. Now various charts. Now these are all the candlestick charts. So first let's talk about abandoned baby top. Now if you are observing this abandoned baby top, what you are going to observe in this? Now there is an upward trend. You will see the first is your green candle and then again a green candle. So that means upward trend and then a lonely doji. This is a lonely doji, and after this a reversal is there. First of all, upward trend, green candles are there, and after that red candles are there. So opposite trend. It is moving upward, then it is moving downward. So let's say imagine a student is climbing the stairs, it's an upward trend, and suddenly he stops in the middle. And he's confused what to do, whether he should move upward, whether he should move downward. And in this confusion, his next movement is he starts moving downwards. And the same thing happens with the stock market. The stock market is a bullish market, and suddenly something happens, it starts moving bearish. Prices are moving upward and suddenly it moves downward. So it is known as abandoned baby top. So in this, when the buyers lose the momentum, the buyers, bullish market, buyers lose the momentum, and suddenly the sellers take the pattern. So that will be named as abandoned baby top. Now second is long legged doji. A long legged doji is a bright fight between your buyers and sellers. Now you can see here the bearish market, sellers are there and buyers are there. And this is a fight between buyers and sellers. Now think of a person, let's say you and your friend, one is buyer and one considered as a seller. You both friends are they are sitting on a seesaw, and all day you are moving on the seesaw. So that means sometimes you are up, your friend is down, and sometimes you are down, your friend is up. But if you will observe, whenever you are sitting on the seesaw, both are sitting at the same level. Whenever you have started sitting on the seesaw and whether you are playing on the seesaw, both are there on the same level. So over here, bearish market and bullish market. That means buyers and sellers have a fight, but at the end they are at the same level. So that is known as long legged doji. Next comes the shooting star. Now shooting star always appears after the upward trend. You can see green candles, they are moving upward, and at the end of the upward trend, it's a shooting star. And in the shooting star, what you are going to observe, there is a long upper shadow only. There is no downward shadow. There is an upward shadow, or you can say upward leg is there. And the body, this is your body, it is small. Okay, let's think of an example. Let's say you release a balloon which is filled with air. So whenever you release a balloon which is filled with air, it will goes up very fast. But if the balloon loses the air, as we all know that the balloon will lose the air after some time. So once it loses the air, it will come down quickly. And the same thing happens with the stock price. If the stock price is moving upward very quickly, there will be the time when it will lose its momentum and it will move down. So prices tends to rise, but the sellers are there who are pulling it back. So which means the danger of reversal. Now you can see green. Green means buyers. Buyers are moving the price upward, but sellers are pulling it down. Next comes your hanging man. Now as you will observe this diagram, hanging man looks like a hammer, but it always occurs at the top of the trend. Now see, the prices moves down and again the prices moves up. So it's always at the upward. You just imagine just like a fruit which is hanging on a tree. When the fruit is hanging on a tree, it looks nice, but it can fall at any moment. We cannot guarantee that the fruit will always be hanging on a tree. It can fall. So similarly, when the prices moves up, It can fall at any point of time. So that is known as hanging man. So when the market looks strong, that we are believing that market is very strong, prices are moving up, but weakness can also come at any point of time. When the weakness comes, so we name it as a hanging man. Next comes your morning doji. Now, morning doji is a bullish reversal. Over here, you can see the bearish market is there, market is going down. It is a bullish reversal. That means, first of all, you will see the red candles, then a small this doji, and then the green candles. So, think like this. There is a dark night, and then you see a morning star. Because after every dark night, morning star is there. And once you see the morning star, it means a sun rises. Now, red candle, bearish market, and suddenly the bullish market. The prices moves up. So we can say the end of the night. Now next is the evening doji star. Again, opposite of a morning doji star. Since this was a bullish reversal and this evening doji star is a bearish reversal. First of all, you are seeing the green candles and then your red candles will be there. So over here we can see that, think of a bright day, and after every bright day the evening star is there. That means finally the dark night will come. So when the prices moves up, it's not that every time the prices will move up, it will move down also. And the last is your hammer. Hammer is your bullish reversal. Bullish reversal means the prices are moving down, bearish, opposite of bearish is bullish. So it's bullish reversal. And this hammer is always at the bottom. Say hanging man was always on the top. Hammer is always at the bottom. So over here the seller tries to push the price down, but buyers bounce back and the reversal take happens and the prices increases. Next, whenever we are using the technical analysis, we take the help of various charts. One is your line chart, where we make a line chart with the help of all the closing price or all the high price or all these your opening price. So make a line chart to study the pattern. Or even we can make a bar chart. With the help of bar chart, we can study the pattern also. And we can use the candlestick chart also. We have already learned what is candlestick and how to read it. So all these candlestick charts make a pattern. Whatever dojis we have done. So morning star, evening star, hammer. So these are the patterns that we are going to study. Now next comes your head and shoulder. Now as you are seeing that this is a diagram and we have two shoulders and one head. One is left shoulder, one is right shoulder, and head is in between. So whenever the prices moves up, you can see over here, your prices are moving up and then down. And again it increases greater than your left shoulder. And then it comes down and again it increases and down. So this is your left shoulder, this is your right shoulder, and in between there is an head. So this is upward head and shoulder. But it can be reversal also. The prices moves down, again it increases, again it moves down higher than before, again it increases and again it moves down. So this is known as reversal head and shoulder. Now when the prices are moving up, it is known as your upward trend. When the prices are moving downward, we name it as a downward trend. And whenever the prices, they don't follow neither the upward trend nor the downward trend, we name it as a stochastic trend. If you have ever watched a child, when the child is moving, it can take any direction. Or if you have observed a fungi on your bread, it can move in any direction. And when the stock prices are moving in any direction, they are not forming any pattern, neither moving upward, neither moving downward, we name it as a stochastic trend. They are moving in its own way. Double top. When the prices increases up, then down and again up, we name it as a double top. Or we can name it as a double bottom. When the prices moves down and then up, then down and then up. And if you will observe the double bottom, we this is like a W and your double top is like a M shape. So what does it explain? That prices are moving up. It tries to move up. Again, the forces are there which are moving the price down. It again tried to move up. And then the forces are there. They are moving the price down. For example, if I say that I have to give the IIT exam, I have to become the engineer. I tried one time. So I do my best to crack that exam. But suddenly I failed. Next time again I tried to crack my exam. And next time also I fail. And then I lose my hope or lose the interest. So I lose the hope of again studying for the IIT exam. So the same way the stock market works. Stock market moves up, but some forces are there who are moving the stock market down. Again, it tries to increases. Again, some forces are there and it moves the prices down. And it happens that it loses hope and the prices goes on decreasing. And the opposite happens in the double bottom. Prices moves down, but some forces are there who are taking the price up. Again, the prices moves down and some forces are there who are again moving the price up, and then it moves up and up. Hope you have understood all these patterns. In the next class, we will be learning about some more patterns of the stock market. Thank you.